this hefty price that Australians are paying for the war in the Middle East will continue to reverberate around our economy, whether it's its impact on prices or on economic growth. And so over the course of the next week or so, what we will do is we'll finalise our expectations. But I tried to be really upfront with people yesterday when we got these difficult inflation figures, really the costs and consequences of what's happening on the other side of the world.
Let's go, guys. Guys, I'm here to talk about the comparison of what industry super is versus self-managed super. We always have that kind of a seasoned understanding based on the information, based on the past experiences, and based on what others have told, and based on the information what we have observed. And what I want to unpack in this video, in this session, is all about demystifying that and making you to better understand and unpack yourself to make a decision what it means and how you need to position itself. This is not a video about telling you to do this way, explaining you what to do, how to do it, and where to go. It's about the information in plain, simple English to make you understand what it means at this point of your life, what that means, what is that information that you need to carry forward, and make a decision that can empower you and make yourself as a smart investor. So if that is very clear, let's move on to the next phase about the technicality on each of these investment settings. Of course, the default and comfortable settings that we have for our maturity and the maturity of our super fund is from the industry super. You name it, there are a lot of industry super providers in Australia, be it CBUS, Australian Retirement Super, Colonial First, HESTA, and there are many other providers which are being regulated by the SEC to preserve the integrity of your super growth itself. So that's one thing that everyone is having it as a common. And any employer super contribution goes into one of these funds managed by these industry super, for that matter. So in this episode, what I wanted to talk about is what we see and what we don't see in these kind of investments, especially what that returns means, what is that the meaning, and then the purpose that you get from out of it, and is it basically driving you to the empowerment in terms of the better lifestyle that you are dreaming for in your retirement phase, or is it something that you are in an illusion which no one has talked about it? Say for example, you have a 320k or 300k kind of an super fund or super fund residing in your industry super. If you do all the math, it is all about around 8 to 9% of the return that you get from the industry super, because it's been managed by the fund manager from your industry super, and you get that kind of a growth. 9 to 10% of 300k is what, 30k approximately. But let's say if you look at the exact number around 320k, and hypothetically with the average return of 7.5%, you are getting around 24k as the kind of the growth. Then you subtract that against your fees, be it admin fee, fund management fee, investment fee, indirect expenses, around $2,800 per annum. And then the tax on earnings is 15%, which is decent, but it is not decent in terms of the earnings itself, because it is depleting the earnings, which is around $3,600 per year. So what you get is, for a 320k fund, the growth is around 17k per year, which is around 5.5% is what you get as the return, as the growth on your fund that you have. And that's exactly the growth. Now the question is, if you apply the inflation rate, especially with the hypothetical analysis of last 5 years, with the inflation happened and averaging out on the inflation for last 5 years, you are sitting at 5%. Though RBA tries to target it around 2 to 3%, but in practical, in an average, in last 5 years, the statistics says that it is 5%, right? So what it means? So you are sitting at the growth of around $1,600 is the actual growth from your fund, that you are having the actual cash that makes you empowered to make the purchasing power. That's exactly the wealth that you have gained. So now the question is, if you leave it in this state, in this setting, in the comfortable setting, yes, of course, industry super comes with the security, regulatory frameworks and everything, which is controlled by the compliance requirements dictated by the regulatory framework. But is it going to empower you in your retirement is the question. So that's exactly is the alternative where you see at SMSF. And SMSF is not every property investment that you make in self-managed super fund, where you have the direct control on the asset selection. You have the intelligent way of leveraging the equity growth from the borrowed money itself that you get from the bank. And also you have the choice of when to enter into the market and when to exit the market to make the right money. And that's exactly is the power that you have in self-managed super fund. So it is not about just getting into SMSF structure, which is all this kind of paperwork, and getting the legal structure and everything is going to cruise you into kind of the growth. The growth is better than the industry super itself. It's about the right asset, right region, right timing in the market, and right time in the market to exit from that asset class, making the profit. And that's exactly is where, if you do this kind of a math, if you look at the right bottom of the cycle of a particular region with the right investor mindset who can empower you to create that kind of an investment portfolio, you should be able to make the same. Let's say if you have a fund of 320k and you are taking around 150k or 170k out of it as a kind of an investment into the self-managed super fund based residential property investment, and you are entering into the right time into the market, into getting into the property asset class, and getting out in the right time, let's say 3 to 4 years, and then making the equity growth of around 100% in there from the point you purchase. Your growth is around more than what you expect in industry super. For example, you don't need to even wait for 5 years. In 2 years time, the realistic data that shows what people have done is selecting the right region and right asset class. A property that has been purchased around 600k has appreciated up to 840k in less than 2 years, which is 240k in capital growth. And when you compare that growth with the investment of 170k as the kind of industry super fund that you have used to purchase this property, all you have is estimated net equity position in the industry super is around 315k. So now if you compare this like for like between industry super and SMSF super, the growth is, you are looking at the value that you get for that fund in industry super is around 190k in less than 2 years. But in SMSF super, in right asset, right region and right suburb, you are getting at around 315k. That's around 130k more than what you get in industry super. That's how the accelerated growth that you can get it. And that's exactly is what makes it well efficient.
Okay, so you're laying out the case pretty clearly. The math shows that if you pick the right property at the right time, you can potentially double your money in 2 years with SMSF, whereas Industry Super gets you that steady but modest 5.5% after all the fees and taxes eat into your returns. And when you factor in inflation, you're barely moving the needle on your actual purchasing power. I get it. The SMSF scenario where you find a property at 600K that jumps to 840K in under 2 years, that's a game changer. You're not just keeping pace with inflation, you're actually building wealth. And that's the gap we're talking about here. 190K versus 315K on the same starting investment. But here's what I'd push back on a bit. Those numbers you're citing, that's the best case scenario. That's the property in the right suburb at exactly the right moment in the cycle. How many people actually nail that? And what about the people who pick wrong? What about the property that goes sideways for 5 years while you're locked in, paying holding costs, dealing with tenants, managing compliance? That's where the real risk sits.
That's a great question. I'm glad that you have asked this question. Basically, here, that's exactly is where you have that kind of an investor hat, not just as an investor, typical investor. You go with the complete understanding of data analysis, and data science engineering to understand data, not just looking at data in a single dimension, but in a triangulated way, which is basically looking at a lot of data points from days on market, median price growth in last 36 months, the vacancy rate, the online search index, and most importantly, what are the economic drivers that are driving the market, and what kind of diversified economy we have, not just on retail, not just on mining, but also on hospitality, hospitality, and most importantly, it's all about the population growth itself. It's not just the economy drives it. The economy should drive the population as well. Population growth in terms of bringing new resources, new occupation categories into the market. And most importantly, that also drives the families into the market, which is bringing the rental demand and rental crisis into the market, which is making these suburbs and regions more hot and hotter as days goes. And that's exactly is what we are positioning as timing in the market in order to enter into the market in the right time to tap in the growth. At the same time, we are predicting the kind of a rental demand and rental crisis which is going to prevail for next 3-4 years. The reason is the shortage of new dwellings, new houses being built in this region, which is kind of creating that supply demand spike, which is what is going to make this region as a kind of a investor supportive, and most importantly investor attractive. And that's exactly is what is going to spike the price on the asking price as we go along in next 3-4 years. Most importantly, because of all these factors is the reason why the rental income is also going to be very attractive not just for the landlords but for the future buyers. That's exactly is the reason why we are so confident that it is going to be the right asset for us to exit as well, because it will be attractive for a future buyers while we are holding it. And that's exactly is what is being positioned as the kind of the high confidence factor for moving into the SMSF based investment in order to tap in the growth and make it more instrumental for the wealth creation for any Australian citizen who is dreaming about. Leon, now do you understand it?
Yeah, I do. You're not just throwing darts at a board. You're looking at the whole ecosystem. The economic drivers, population growth, rental demand, housing shortage. You're triangulating all these data points to identify where the market's heading before it gets there. That's the difference between a gamble and an informed investment decision. So, when you talk about picking the right property at the right time, you're really talking about doing your homework. Understanding which regions have the fundamentals that are going to sustain growth, not just short-term speculation. Population coming in, diversified economy keeping it stable, housing shortage pushing up both prices and rents. That's what makes you confident you're going to be able to exit at the right moment, because the fundamentals are still going to be there, making it attractive to the next buyer. That's actually solid. That's not luck. That's strategy.
So guys, that's exactly is what I wanted to present to you with the information pack. Not all industry supers are the wealth accelerators or having the growth potential. At the same time, not all SMSF based investments is also going to provide you the default of the wealth acceleration in terms of enriching your fund capacity, the capacity that you require for the lifestyle that you're after in your retirement phase. So this episode, we were able to cover extract the interview session that was with a potential customer who goes by the name Leon. And he was trying to explore what he gets from SMSF based investment in terms of the accelerated growth. At the same time, what all the parameters and due diligence that has to be put in place in order to be much more efficient and much more powerful than the growth that any individual would receive from the industry super. And as you could see, there are lots of insights, data science, and most importantly, the on-the-ground insights about from region selection to suburb selection to street profile to the growth the market has in that region, and most importantly, how that translates into the investment in terms of the residential property investment through self-managed super fund. I hope, guys, this gives you the better idea of what industry super is currently doing in terms of the growth, contributing in terms of the growth for your readiness on your retirement phase. What if you leave it in your comfortable state, the comfortable state that you have right now from industry super, what that growth means with a hypothetical example that we have shown, and most importantly, how that translates into more research oriented investment that you can make in your self-managed super fund to have an accelerated growth, also minimizing the risk based on the data and based on the decision that you make. I hope, guys, this gives you a better understanding where you need to move forward in terms of the wealth accumulation for your retirement phase. That's all from me, guys. I'm Varun from Future Secure Advisory. I look after property investment in high growth, high potential, high rental yield based properties using data science and data science engineering from region selection all the way to the property and asset class selection itself. That's all from me. Have a great day. Thank you.